Because disruptions within the banking system can be costly for society, governments provide a safety net and regulate banks. This regulation is burdensome, but our belief is that it allows the banking system to run smoothly and efficiently. In this session, we will examine shadow banking. Shadow banks are another set of institutions that provide similar financial services as banks. However, shadow banks are subject to less regulation. This presents an immense challenge for bank regulators, especially when they have limited authority to intervene. Our goal is to understand the risks at shadow banks and recent attempts at regulation. We will focus on money market mutual funds as a case study. Our discussion of the banking system has come a long way. It might seem odd to bring this up now, but in order to define a shadow bank, we must first agree upon a definition of a commercial bank. Under the 1956 Bank Holding Company Act, a commercial bank is an institution that accepts demand deposits and makes commercial loans. It does both of these activities under the same roof. Over the years, many institutions have emerged that provide commercial banking services but are technically not considered banks. Some of these institutions fund illiquid assets like corporate or retail loans. For example, a mortgage-backed security, or MBS, is a portfolio of mortgages. A corporate loan mutual fund is a portfolio of corporate loans. Other institutions may fund their operations by issuing liabilities that resemble demand deposits. A repurchase agreement allows cash-rich firms like pension funds to store their cash and recover it at short notice. This serves a similar economic function to a bank deposit. Some institutions do both. They issue deposit-like liabilities and invest in illiquid assets. The classic example is a money market mutual fund. This is a mutual fund that funds itself by selling fixed value shares. I can put $1 into a money market account and withdraw it at short notice for $1 plus maybe some interest. These shares are marketed as savings accounts. From a customer's standpoint, they serve the same function as bank deposits. On the asset side, the money market fund invests in a variety of debt instruments. This is basically what a bank does. It issues deposits and invests in illiquid assets. So for this reason, money market funds are often called shadow banks. Some hedge funds that rely on short-term debt funding are also considered shadow banks. On the other hand, non-banks such as insurance companies are not considered shadow banks. While insurance companies do invest in long-term illiquid assets, they are not funded with liquid liabilities. Why do we see shadow banks? Well, perhaps they are specialized financial firms that are more efficient than banks. A popular counter-argument, however, is that these institutions can provide the same services as banks, but avoid the regulation. Hence the name. These institutions lurk in the shadows, hidden from regulation. So what's the problem with shadow banking? You might see it already. Shadow banks are exposed to liquidity risk. If we allow shadow banks to issue deposits, then won't they be subject to depositor runs? The short answer is yes. This is a problem that was solved for commercial banks over a century ago with the introduction of the government safety net. Shadow banks are fragile because they do not have access to the government safety net. Shadow deposits are not insured by the FDIC. This means that shadow depositors have an incentive to run on the shadow bank if they are worried. Shadow banks cannot borrow from the lender of last resort during a financial crisis. This means that if a run is taking place, a healthy shadow bank might run out of cash and fail. These institutions face limited government regulation, so during a crisis, they are not supposed to be bailed out. However, we shall see that money market funds were bailed out in 2008.